ASIC and other stakeholders remain focused on how organisations have considered the impact of COVID-19 on their financial statements. Our review of 30 June 2020 reporting identified some improvement areas needed to the disclosures of the impact of COVID-19 and the estimates and judgments that were made in the preparation of the financial statements in order to meet the expectations of our regulator. In our webinar, we run you through what these improvement areas are. If you're looking for a recap of the recognition and measurement impacts of COVID-19 on the recoverable amounts of non-financial assets like goodwill, other intangible assets, PP&E, guidance on expected credit loss provisioning or accounting for the various government stimulus measures that were introduced like JobKeeper, or even considerations around the going concern basis of preparation, then I do refer you to our webinar recording on 30 June 2020 reporting, part 1. As part of your 31 December 2020 reporting, you were going to need to consider the announcements that were made as part of the October federal budget. One key measure that could have a significant impact is the tax loss carryback provisions. If you're an organisation that is currently loss-making or expect to make losses between now and the years ending income years 21 to 22, and you paid tax in the 18-19 year, then you're going to want to have a look at this measure because it effectively will give your organisation a tax refund. What it could also do is it could enhance the recoverability of any previously unrecognised temporary differences, with the benefit of this being recognised through the income statement. If you're a lessee and you were able to negotiate rent concessions directly as a result of COVID, then even if you are applying the practical exemption from lease modification accounting, given that the amendment doesn't actually provide any accounting guidance on how to actually account for rent concessions, then it will be an area that you will want to have a look at sooner rather than later, as your auditors could have very specific views on what the accounting should look like. In the webinar, we run through our view of how a very common concession should look like. It's one where rent is waived for a period of time. As usual, your 31 December 2020 reporting preparation should also consider the newly effective standards, amendments, IFRIC agenda decisions, and ASIC area of focus. Luckily, this 31 December, there's really just limited scope amendments that are needed to be considered. But if your organisation did acquire a business with concentrated assets, then the amendment to AASB 3 dealing with business combinations might be a good one for you to have a look at, because you might find that if you meet certain criteria, then you may not have to do business combination accounting at all, and you might not have to recognise goodwill and any deferred taxes associated with this acquisition. In terms of recent IFRIC agenda decisions dealing with transfers of football players, deferred taxes associated with undistributed profits of a subsidiary, and sale and leaseback transactions with variable payments, we do think that these will have limited impact. However, for completeness, you will need to go through the detail of these IFRIC agenda decisions, look through the newly effective amendments, and work through whether these are relevant or not for your organisation. In terms of ASIC's area focused, while they haven't released their focus areas for their 31 December 20 surveillance program, we do expect them to continue their focus on COVID-19, especially in regards to impairment testing and disclosures of non-IFRS financial information, revenue recognition, and the application of AASB 15 also is likely to be a focus area for them. Another regulatory development that might have implications for you is the new payment times reporting requirements, which basically requires large businesses to report publicly every 6 months on their dealings with small suppliers, small businesses, including payment terms that are adopted. So if your organisation engages in supplier financing, otherwise known as reverse factoring, then there will be, I guess, heightened interest in these disclosures that you'll need to start making from 1 January 2021, because we are aware that ASIC is particularly focused on how organisations are disclosing and presenting these types of transactions in their financial statements. If you're a December year-end organisation, then a reminder that the thresholds for lodging accounts and reporting to ASIC has doubled. And if you are, so that's something that you will need to work through. If your organisation still needs to continue to lodge accounts and historically have prepared special purpose financial statements, then we do strongly suggest that you reassess your ability to prepare these types of accounts. While it's still possible that you could prepare these types of accounts until June 2022, we do know that at the time that the thresholds were doubled, both the accounting standards that are so the AASB and the regulator did make some observations that did, I guess, indicate to us at least that this would be a focus area for them. So these are the areas that we run through or highlight for you in our 31 December 2020 reporting webinar, and we do encourage you to have a look at that recording, and good luck with this upcoming reporting season. Thank you.